Consumer groups are calling on the government to extend an interest rate cap on short-term loans in an attempt to shut down dodgy loan sharks. An alarming number of Australians are taking out high-interest short-term loans in order to pay for everyday expenses. The government is looking at ways to control the industry, but the big banks are showing an interest in the market. Emily Stewart reports.
The big banks are on the hunt for loan sharks and are wading into the murky waters of the short-term loan market.
We feel we have a role to actually, one, help extend finance to people who normally can't access it, but do it in an affordable, sustainable way, but also be part of the debate that says this is not the right practice.
With staggering interest rates of up to 700%, short-term loans are being taken by more than 500,000 people each year, with many using the money to pay for bills, rent and food.
High cost, short-term lending really is a form of subprime lending, the extension of credit to those who cannot afford to borrow.
Industry regulations were tightened in July when ASIC set out national responsible lending requirements for all non-bank lenders. But consumer groups want more to be done to protect vulnerable borrowers.
What we'd like the government to do is bring in a national comprehensive interest rate cap, which really limits the price of consumer credit in Australia to 48% APR as an absolute maximum, which would mean a lot of these products simply wouldn't be available.
Last financial year, the biggest short-term lender, Cash Converters, lent consumers around $150 million, way up from $11 million in 2002.
There has been some growth for a number of reasons, not least of which we've established ourselves as a legitimate and trustworthy lender.
The National Financial Services Federation doesn't believe a cap will work, saying interest rate caps do not address the real market failure, debt spirals. No interest rate cap can stop a debt spiral. It's Math 101. The big banks say they support the cap and are now providing their own products with interest rates of between 14% and 28% to pull customers away from non-bank lenders.
What we're really trying to tap into here is people who normally find it very difficult to access finance from a bank, for example, and are then going to fringe lenders who really end up charging them very high interest rates, and they end up getting caught up in debt that they cannot manage.
They say it's a community service, but it needs to be commercial to survive.
Some of the work that we are doing is to say, well, how can you actually provide loans like these at affordable interest rates, but also sustainable interest rates, such that at the end of the day, maybe it's break even or very small amount of margin.
But a NAB report into fringe lending found that for the lender to break even on loans between $1,000 and $5,000, an annual percentage rate of almost 33% is the minimum required. The National Financial Services Federation Chief Executive Phil Johns says, bottom line, it's a great spin job by the NAB and others, but I stress they aren't providing or creating an alternative lending product for our industry sector. The banks too are reticent to relax lending criteria, with another NAB report into their own small loans program finding 94% of applications between April and June this year were rejected, leaving little hope for people most in need of an urgent loan.